All right, let's jump into it. So I've written a few articles about how the banking system in the U.S. and a few other countries is pretty much fucked, and the crucible this time are these smaller U.S. banks that have been failing. Can you want to walk us through that, like from your perspective as somebody who's studied the money markets quite in depth and written about them?
Well, I mean, the problem of small U.S. banks is, small U.S. banks specific. I think this is basically an episode where the large banks are largely insulated from the problems because they are experienced in terms of managing interest rate risk. They are experienced in managing duration risk, which is just fancy for being ready for a rising interest rate environment. Some of the smaller banks that got into trouble were obviously not as well versed in these. SVB would be one example where I think it was kind of like a perfect storm. Anybody who lived through the great financial crisis and remembers the hedge funds that Bear Stearns used to run, I forget what their names were, but they were basically the most complicated levered assets on the asset side, and then on the other side they had the shortest liabilities. I mean, SVB was an example where the liability structure was unfortunate because they banked for a bunch of venture capital and tech investors. And if you were to look for one asset class that imploded after interest rates started to go higher, was the long duration growth stocks, right, and the whole tech universe. So the investor base has a liquidity problem. It's pulling it away from the bank that they mostly bank with. And on the other side, SVB had a lot of venture capital loans and also a lot of long duration securities which fell in value because they didn't really know how to hedge those risks. So the asset side went bad and the liability side went bad, and so lesson learned. First Republic was a different story. I guess, we all read the stories about them making interest-only loans.
Yeah, I had a friend who was telling me that him and his boys, they bought a Hamptons house.
Yes.
And they were like, the bank was like, yo, no money down. He was like, really? And interest only for like whatever many years? He's like, sign me the fuck up.
Yeah. Well, a friend.
You must be retarded to give me this thing.
A friend texted me that when I got my mortgage from First Republic, I did not know, my friend didn't know what a good deal I'm getting. But next time I told him the next time he gets a mortgage that's too good to be true, we should just short the bank stock that gave it to you, and maybe it's gonna pay itself off fast. But yeah, so it's basically lessons in not being able to run interest rate risk, not being able to not knowing how to make a loan that actually is going to be weathering a rising interest rate storm, and so that's what that is about. I think it's also very important to point out that the response that the Fed had has been quite impressive. I have never seen a Fed that is this proactive in keeping a crisis from happening. I mean, it's
So do you think that the bank term funding program actually has addressed the root problem, or sort of half of it? It's only treasuries and MBS.
It's only treasuries and MBS.
Commercial real estate or any of the other dog shit that they have on their balance sheet.
Exactly. It addresses half the problem. And I think it's more like a kind of foaming the runway for any of the large banks that might be having problems down the road. But it's a facility that exists. It's extremely generous. I mean, it basically tells you that whatever mortgages you have underwater in treasuries, just please pledge it at par. So that's it's quite generous. And then of course there's this other lending that's done to the FDIC, and then from the FDIC to the troubled institutions that's kind of keeping things in peace. But again, I think there is a playbook to manage these case-by-case banking issues as they have come up and as they will probably continue to come up. And so, the system is fine, so to speak.
So you wouldn't be in the school of thought where, we kind of had this lull period where, a few banks went bust, some equity holders got wiped out, markets kind of, treading water a bit. Then come the fall after debt ceiling and a bunch of treasury instruments, shit just really goes fucked up.
Mm-hmm. Well, prices are going to get pushed around, but there's a ton of cash in the system. I mean, the way I explain this to people is there is this facility at the Fed called the reverse repo facility. It has $2 trillion of cash in it, which is basically the system's cash under the mattress. that $2 trillion is money that is not bid for by any financial institution. No bank wants it, no dealer wants it, nobody wants it. It's just parked by the money funds at the Fed. So if the bill issuance comes, and if coupons need to get funded after auctions or whatever dollar needs the world has, I mean the money is there. Just please bid for it and mobilize it. So it's just very hard to see the ways in which the system would kind of.
So do you think that the reaction of gold and Bitcoin to some extent, seeing through this bank term funding program as highly inflationary, if they have to really put all these bonds to the Fed to refinance, do you think ultimately they are backdoor expanding their balance sheet, but not in a way that we would consider QE or the traditional programs that we're all used to now?
Yeah, I mean, look, my view has been that QE will have to get restarted. We are just that.
Why do you think that?
Why? Well, because it's ultimately a government funding question, right? I mean, the government is going to have to get funded, depending on whether, it's basically going to be a question of how much tolerance there is for treasury yields to kind of cheapen relative to all the derivative curves. I mean, I'm talking to a non-technical audience, so the treasury OIS spread is what it is, so the swap spreads can't really get out of place, and so the Fed is probably going to restart QE to keep a lid on treasury yields.
So some sort of like soft yield curve control, or
something like that? Yes. I mean, we are in the anteroom of that, right? I mean, I like to say that everything in finance is a hierarchy, and you need to think about everything in terms of a spectrum. Number one, BTFP. It's kind of like here's underwater stuff. We'll make it par. Buying back off-the-run securities and replacing them with on-the-runs to kind of improve the liquidity in treasury market is another form of that. Skewing the treasury issuance from the back end of the curve to the front end section is another way of kind of making sure that yields are kept under control. So there's many telltale signs here. I think that making sure that the treasury market functions properly is extremely important and is top of mind for.
And do you think that other countries have a similar set of problems where you have a banking system that lent all this money at historically low rates in 2020 and 2021, inflation's rising everywhere, central banks raising, banking system goes underwater, but this is not just purely an American thing, it's a European
thing. I think so.
I think it's an Australian thing.
Yes, I think, the Bank of Japan is not raising interest rates. But they loaded up on a bunch of foreign bonds, these issues are basically hiding and lurking everywhere. We've had a similar issue in the UK with the mini budget and the sell-off of the long-dated yields there, but that hurt the pension community more. So I think these things are in the system, and then depending on how much higher interest rates go, who gets hurt, to what extent by the real estate problems in the commercial real estate sector. I mean, these problems are going to continue to bubble up.
Right. And inflation, right? So every, month and a half, everybody's all up and excited. Okay, what's the Fed going to do? 25, 50, 0, pause, hold, future path, blah, blah, blah. And you've written a lot about how you think inflation is quite sticky here.
Yeah.
Maybe it has declined a bit. But the underlying structural forces that have generated these problems are not being solved, nor can they be solved in the short order. So where do you see the path of inflation?
Yes.
And then does the Fed actually respond to it and keep raising and continue to fuck the banking system, or cut and everybody gets Lambos again?
Well, the Fed has been responding to it. It's a sticky problem. I mean, I think there's this view that you hike interest rates and you fix the inflation problem. It's not as simple as that. I like to remind people that even Paul Volcker, who is a legendary central banker, everybody thinks of his achievements as he raised rates a lot and inflation collapsed after. Well, I think Paul Volcker without a doubt, he was a legendary policymaker, but he was also lucky. So let me just give you two examples why. The first one is, the OPEC oil price shocks that happened in the early 70s that served up most of the inflation problems later on, they happened a decade before Paul Volcker came to the Fed to be the Fed chair. So over that decade, we've had a lot of investments in oil and gas exploration. So that's the period when the North Sea oil fields in the UK were developed. The Norwegian Sea was developed for oil fields. Texas was drilling, Canada was drilling. So there's a lot of supply that was coming online. And then by the time Volcker raised interest rates and the economy fell into a recession, there was a flood of new supply of oil and gas, and basically energy prices collapsed. So that's great, right? The second thing, the political economy and the underlying fundamentals in the labor market were very different. I mean, that was a period when women were entering the labor force, so there were more labor than you knew what to do with. Politically, 1981 is the year when President Reagan fired air traffic controllers because they dared to go on a strike. So, these are things also working in his favor, right? Because you have a recession, but there's a number of people coming into the labor force. The politicians don't like wage price indexation anymore. And today it's the exact opposite. I mean, we haven't invested in oil and gas for close to a decade, and that applies basically to every commodity imaginable. And digging for commodities is dirty. Geopolitics back then was probably, you had that flare up in the early 70s, but then it calmed down. Today it's just flaring up. And then the labor market is just fundamentally different because we have a labor shortage, especially in all the low-skilled workers that the service industry relies on. And politically, I think, kind of skewing the distribution from capital to labor is actually trending, so to speak. So, the inflation backdrop and the fundamentals when it comes to what is going to drive inflation going forward, this Fed is not as lucky as Paul Volcker used to be.
But do you think that Powell knows that? Because obviously he's trying to be the modern day
Yes.
Paul Volcker, but the situation is
I think he's
different.
going to try very hard to bring things down. Again, I think he has an impossible job because again, there's a famous quote from Herodotus, which is that circumstances rule men. Men do not rule circumstances. You're just kind of parachuted into a situation and you got to deal with it. But I'd like to give him the benefit of the doubt that he's going to try his very best and keep things as tight as necessary. But again, that's kind of a question mark at the moment because we are about to pause
Right.
in terms of the interest rate hikes. And I think the Fed is always in this mode of trying to see, trying to It's tight in a forward sense because real interest rates are positive in a forward sense, but not in a spot sense. And so in a bit, we are always waiting for something to serve up an extra tightness to kind of get inflation down, and then real interest rates are going to be positive.
So in your mental model of, say, the next 6-12 months is Q4.
Welcome back. I'm Pete Rizzo, editor of Bitcoin Magazine. We're here at the Bitcoin Magazine live desk presented by Marathon, joined once again by our special guests, Ran Neuner and Aaron and Austin, co-hosts of Altcoin Daily. Before we go back to the main stage, we're going to give a quick plug for the new Bitcoin Magazine on newsstands now at bitcoinmagazine.com/store. Look, the Julian Assange cause is important. He's a journalist of the highest order. He deserves your support. You can read about him more in the new magazine.